Hello and welcome. My name is Simon French and I'm Chief Economist of Panmure Gordon. Today we're going to take a look at what the prospects are for global labour markets as a result of COVID-19 disruption. There have been significant spikes in unemployment, most acutely in the United States, but also in Europe and in Asia, as a result of the disruption and the very changed economics for big parts of the services sector in particular. And that is in sharp contrast to what investors have become used to over the last 2 to 3 years, where the services consumer-based economy has been the strong part of the economic infrastructure at a time when manufacturing and trade was seen to be under pressure from tariffs and the potential US-China trade war. It's very much flipped around as a result of COVID-19, and actually it is entertainment, hospitality, travel, those areas where consumer spending had been strong, which is actually most under pressure as ongoing social distancing measures pretty much around the world in advance of a vaccine being available, has really inhibited companies exposed to that kind of spending to be able to achieve the same economics going forward. And there are big implications regarding employment. And as governments consider going into the second half of the year how they respond to that, one of the big concerns they will have is that a potential consumer spiral downwards starts to take place if consumers reluctant to spend because of a public health concern start to lead to layoffs in that very sector, which start to feed back into household incomes and start to constrain those households that are happy to spend from doing so. This negative multiplier effect is what public insurance against unemployment schemes such as furloughing in the United Kingdom, job retention schemes across Europe are trying to avoid. Now, many investors will be uncomfortable with the scale of government, public sector interventions in the labour market, which normally, in normal times, governments, the public sector leave to the private sector to clear. But these aren't normal times. And I think investors should get used to the fact that significant employment subsidies, or indeed heightened unemployment insurance, is going to be a significant part of the economy going into 2021 and indeed beyond. And actually, from a macro standpoint, that is exactly what a public sector balance sheet backed by central banks should be looking to do. And for those invested in fixed income, they're going to have to get very used to government balance sheets, central bank balance sheets, being materially higher than they were preceding the crisis, and actually staying up at these multi-trillion dollar, multi-trillion euro levels like we have seen during the course of the second quarter of the year. So as we kind of sum up what that actually means, for a lot of consumer discretionary companies, the real pickup in month-on-month data that we have seen in the back end of May and June into July needs to be set against the year-on-year metrics in terms of retail sales, consumer discretionary, which are still down anything between about 10% to about 40%, depending on which jurisdiction you're in. And it is those economics that are going to really drive whether the existing corporate structure of jobs, companies, the layout of the consumer economy is going to remain the same post-COVID, or whether there's going to be material scarring, which the governments around the world can't lean in against, and we see a very different pattern of consumer spending for investors to assess going into 2021 and beyond.